Thank you, everyone. We're going to be prompt. Starting with our next panel, Democratization of Alternative Investments with Dani Burge and John Koudounis. And I want to start by introducing my colleague, Dani, because what I really appreciate about Dani is when I get up in the morning, she tells me what's going on. And with a good demeanor and that smile, I really appreciate it. And I want you to come up to the stage, but I want to give you a little introduction to John and part of our history, because I want to rope into John and I are both Chicagoans. Our paths crossed. We both worked at ABN AMRO. And John is with Calamos right now, a sponsor of the event. Thank you very much, John. But John went to Mizuho for a while, and I want to proceed with that because I was at IBJ, which was Industrial Bank of Japan, which became part of Mizuho. It was a combination of IBJ, Fuji, and DKB. And the reason I bring that up is having gone to, I think it was 15 years ago, first time I went to China, and having worked for the Japanese, I'm like, I've seen this before. A rapidly advancing emerging market that just de-emerges. TDP in Japan right now is like 4.4 trillion, the same as 1992. GDP in China is 17 trillion, it went up too fast. And when you become a decisive enabler of events and wars in the Middle East, according to NATO, that might hurt things. So I want to bring you up now and point out to me, from a macro standpoint, from an alternative standpoint, it makes me, and certainly what you heard from Reza and Norio, is the tilt towards gold from a commodity standpoint. I keep everything, it just makes me alternatives. So gold, I think, is like somewhat of a foundation alternative investment. And then I look at things like Bitcoin and cryptocurrencies as like high beta alternative investments. And John, I think you're going to dig in more deeper than my limited commodity knowledge. But the stage is yours. We appreciate you being here. And one thing I do enjoy about being from Chicago is John's Greek heritage. I'm Lithuanian, and you guys always have the best food. So thank you.
Thank you.
Thank you, Mike, for that introduction. Just to be clear, I'm on Bloomberg TV. I don't just wake him up every morning and tell him what's going on, although I'd be happy to, Mike, anytime. Thank you all so much for joining. I'm really pleased to have John here today to have this really interesting discussion. And John, I mean, it's really of the moment, this idea of democratization of alternatives. To focus on sort of the liquid alts part first, I mean, it's been a real growth in the industry, an industry which you and Calamos have been part of for decades now. It's been a trying time for some strategies. If rates have gone higher, now they're on their way down. How do you see the industry at this moment of what's in demand and what investors really want from liquid alts?
Sure. Well, I should probably start a little bit by talking about our heritage, our firm. John Calamos is our founder. We've founded a firm just over 47 years ago. And his reputation precedes himself in the convertible bond market. He's written a couple books, and people can say that's kind of the beginning of some of the liquid alternatives. It's also part of our heritage. It's the risk management of convertibles that we carry on in all the products that we do. And it's just the innovation. He had built some models for pricing that were ahead of its time. We have developed a liquid alt suite that is top 3 in the world. The only people that are bigger is JP Morgan Asset Management and BlackRock. And so it's something that we feel, and it's part of the name of our session, democratization of products. It gives mom and pop and most of the retail market the ability to invest in products that they couldn't normally buy. Now, in this, to answer your question in terms of this rate environment and what's happening as we start to go down in interest rates, we find some of our products, specifically our ETFs this year. We've launched over a dozen different ETFs in structure protected, 100% downside versus certain indices. We've used S&P, the NASDAQ, and the Russell 2000. And what the structure is, you can buy an ETF, and if you hold it for the year out, there's a cap rate given the options that we trade. And we started at the S&Ps, and they were in the high 8s, and now they're a little bit lower than that as rates came down. But you can get, let's say, 8% of the upside of the S&P for the year. But if it falls during the year, you're 100% protected on the downside. So you protect your principal. And what has happened is a lot of people are very interested in that because as you look at these markets at all-time highs, you're saying, is this the right time to invest?
Well, to that point, John, if I can jump in, because the thing that would usually protect you, just as a retail investor, easy thing to buy is something like a bond fund. Buy TLT, buy bonds. Is there a sense now, just given the volatility we've even seen in the bond market, that that's not enough, and you have investors and more different types of investors wanting these products?
Well, people still remember zero interest rates, and the bond funds were not performing that well in terms of lower rates. And so if you could get equity exposure, people want to get that, but they're scared. So if you can do it in a risk-adjusted manner, that's why we're seeing a lot of interest in these ETFs, because you can get equity exposure and outperform typically over time, your bonds. Our flagship fund is called a market neutral, which is a combination of convertible arbitrage, hedged equity, and merger arb. And that usually trades around, call it 350 basis points over SOFR. And that is sold, even though it's mostly equity exposure, it's sold as a fixed income alternative. And it did very, very, very well when rates were at zero because you're earning 4% at a very liquid product with very, very little volatility.
You mentioned how the foundation of Calamos is this widening breadth, is more innovation. As more players come into the field of liquid alts, as more ETFs are offered that offer these types of strategies, what does it take to stand out, to keep offering products that people want in a more crowded field?
Well, there's been a couple other firms that have been very successful in the active ETF space. And let me say the active ETF space is a little bit newer than just regular ETFs that were passive that when they started. Around 2019, we started seeing, because of some changes in regulations, a lot more managers come in and issue active ETFs. We're an active manager. Everything we do is active. And so pre-2019, it wasn't really in our DNA to be in this market, but now it is. And so how we differentiate ourselves is we look at we try to listen to what investors need, want. And in these volatile times, whether it be the elections, whether it be the wars that are going on in the world, people want risk management. People want to have security in what they're investing in. And so we try to give that to them. John Calamos, our founder, was an Air Force pilot. And he will always say, you better know what you're doing before you get on the plane than after, and do your homework. So risk has always been something that we try to mitigate and navigate.
But John, aren't there still just a lot of investors who think, an alternative ETF, I'd like a 3 times leveraged NVIDIA ETF, please? Isn't there a lot of demand also for not just protection against risk, but it seems like we're in this environment that people want that type of upside?
They absolutely do. And so they have to understand with that upside comes downside, especially in some of the levered products. So it depends what each individual's appetite is. We have found a lot of the paper that we're issuing right now is very, very, actually, a lot of the retired people, they want exposure, but they don't want to go nuts. They don't want a ton of risk. And so that's something that we're navigating through and finding that market. And the 100% risk protected, downside protection is really resonating. And there's others, you can do different bands, like you can do 90% protection and have a much higher cap rate. And those sell very well too. But just knowing that you can protect your money over the course of the year is something that people are looking at, especially during these volatile times.
Yeah, I think our Bloomberg intelligence analyst calls those funds boomer candy, I think is the phrase he uses, which is nice. Are there still any gaps in the liquid alts market that you see that you want to address or you're working on addressing in terms of building new products?
So one of the things that we're really excited about is the whole private market. And we started last year with Axia Capital, which is a a great firm in the private world. They're a consultant as well as a manager. And we partnered up with them and put what they call an interval fund out in private credit. And it's done very, very well. And we're incubating a couple of hedge funds. And we're also launching a private equity fund as well.
There has been some criticism in more retail-like private credit funds. And the critique usually goes something like there's a liquidity mismatch, that having the ability to pull funds out quarterly, even daily, if it's the case of an ETF, doesn't work for a type of asset class that's so illiquid. What do you make of those arguments?
Well, the structure, I think, is actually phenomenal because you're never going to get complete liquidity if you're going to be in that product. But if you can get some liquidity, like they're gated at about 5% per quarter, right? And so unless there is a complete run on the market, you typically, as the fund grows, and it's for the entire fund, it's not just per person, you're going to have the liquidity that you want. And the diversification that you want to. For instance, in our private credit, it's not just direct lending. It's real estate lending. It's real assets. It's distressed. And so you have every part of private credit diversified, which over time gives you better results and a lot less volatility. And our manager, what we do is we have Axia, who are the professionals in private credit. They run that part of the portfolio. And we run the liquid, because we are experts in liquid alts, on the liquidity part. So if there's ever redemptions, we are ready, and we do the math to make sure there's never any runs on that.
Yeah.
Now, the interesting part, and what makes these products so good, is that there's no K1s. And for those people that have invested in private markets, they're always late, and you always have to defer your taxes, and it's a pain. You get invested the minute you put your money in. And our returns over the last year have been approximately 12%, on a monthly basis that we pay out a dividend. And so you have some liquidity. You get your money invested. You don't have to wait 3-4 years for calls. And, it's treated like a regular mutual fund.
Do you think, though, there is, of a risk of more regulation around these types of private credit funds, private capital funds in general, if they are now more increasingly available to retail audience? If they are democratized, does that bring regulation with it?
Well, let me tell you, it's not easy getting them issued with the SEC. It takes a long time because they're very, very scrutiny. One of the major points that I didn't make is it's the first time that mom and pop, for a small piece, $2,500, could invest side by side with Apollo, Blackstone, Carlyle, and so all of those, which are part of our funds, they can invest side by side at a small entry part. So, are there increased regulations on that? There's depending, on the administration, you'll get a different level of regulations, but there's a lot of scrutiny before you can launch one of those funds right at the onset.
So you think regulations are already okay as it is? Like investors are already protected for the most part?
I think that we're seeing even the traditional, like Carlyle and Blackstone, BlackRock, they're issuing these interval funds. So I think this is the wave of the future. I think true privates, for sure, for SMAs and for the sovereign wealth funds that need specific needs with a large size, those will continue to be completely private like they have been. But I think more for the capital markets, we're going to see a lot more issuance in this wrap reform.
Part of the thing with democratization is there needs to be sort of the educational element to it too. How are you seeing investors of Calamos products, your clients, their understanding of this? Has it kept up with the growth of the industry and the innovation that's happening?
Well, we've seen the firms that have done the best in terms of sales and growth in this product are the firms that provide research and are able to talk about it and educate the market on what these new products are. and that's something that we're continue to try to work on in order to do. But it's important that we get that out there, and those are definitely positives. And as more people start to hear about them, I think that the market's just going to continue to grow.
Just to bring it back around to active, because you mentioned this big growth in active. I think of the about 500 funds, ETFs launched this year, about 75% of them have been active, which is just a huge share. What is unique about this year, this environment, where not only are we seeing more launches, because you talked about some of the regulatory easing that allowed for more of them, but that investors actually want them this time around, and they're not just saying, hey, I can go buy a cheap passive fund, let me stick with that, but they're actually buying these funds. What's changed?
Well, a couple of things. Number one, as people get educated, and there's different strategies that you can do as an active manager. And you can mimic some of the mutual funds that were traditionally out there. So that's something that, as a passive, that you don't get. So there's more variety, right? And as people start to understand some of the tax advantages of being an ETF versus a regular mutual fund, that's also another added plus for people to go through that. And you've seen a lot of, and we're probably going to see a lot of conversion too, of some of the traditional funds into ETFs in that respect. So the market's here, it's not going anywhere. The reality of it is most of these indices and in the passive world, in terms of you would issue paper and you'd be working for 5 to 10 basis points, and that's something that unless you have the volume of a BlackRock, it's very difficult to be in that business. Right. Now, in the active space, even though you're not getting as much typically as your mutual funds, it's a lot closer in terms of the fees that are embedded in them. So, I think that's a part of the reason why you're seeing a huge growth.
Can we talk about some of the new funds you're launching and you're looking at? Because you're getting a bit creative. You're going into assets like crypto. Can you just explain some of what's coming on the docket and what your thinking is behind them?
Sure, and I can say this because they're registered and we're waiting with the SEC. So we have a suite of these 100% protected ETFs, and we have them in S&P, NASDAQ, and the Russell 2000. Well, our next iteration of that is going to be in Bitcoin. And so we're waiting for the options market and the flex options market to get the go from the regulators. And so we can offer now not just the three indices that we spoke about, but for people that have never bought Bitcoin or want to buy Bitcoin but are scared that in the last decade or so, there's been about 3 years that it's really fallen tremendously. You can buy Bitcoin now, and just like in the same manner, well, you will be once approved, and be 100% protected on the downside. So you'll have a cap rate, which would, I think, given the volatility of the market and stuff, will be higher than any of the other indices that I spoke about. And so you can capture some pretty good returns and be protected and not get the 85% down or what have you that crypto's had, up and down in the last several years. So think about mom and pop, think about grandma and grandpa who have heard a lot of this, or the retirement funds, but were scared because they didn't want to lose their principals, especially as they're retiring. They can participate with a good amount of the upside and be protected in the downside. We anticipate to be huge demand for this product.
I love the vision of grandmothers and grandfathers everywhere all of a sudden talking about Bitcoin. It's a beautiful feature.
I think we need to get everybody involved. Yes.
I love it.
It's here to stay.
John, thank you so much. Everyone please join me in thanking John Koudounis.
Thank you.